Thank you, Sandeep, and welcome back, friends. So, friends, we will continue from where we have left yesterday. We are just discussing about depreciation, and all of you know, as you know, that there are three methods with which we have to deal mostly. One method is straight line method, and in straight line method, you know what you have to do. In this method, it is assumed that depreciation follows a straight line. As the building advances, so as we have already discussed, that if the age of the building is 20 years and the life of the building is 60 years, total life of the building is 60 years, and if 10% is salvage value, 90% of the value will depreciate in 60 years. So we can find out 90 upon 20 into 60, that will give you 30% value has been depreciated in 20 years. And the second method, in sinking fund method, what we assume? We assume that owner would keep apart a small sum every year as security, so that at the end of the life of the building, the fund grows enough to provide means for rebuilding the structure. And this, you know, this is a basic thing of this sinking fund. So the depreciation at any intermediate stage. Now in sinking fund, you must understand this thing. The depreciation at any intermediate stage is amount collected in the security up to the date of valuation. In sinking fund, depreciation is equal to the amount which has been collected on the date of valuation. Now see, what does this mean? So how much amount is deposited every year as far as sinking fund is concerned? How do you calculate that amount? How do you calculate the amount which is to be deposited every year in the as a sinking fund? We have discussed this in yesterday's lectures, and in previous week's lecture, we have discussed this thing. What is the amount? How will you know that this much amount is to be deposited? If you have to get 1 rupees as sinking fund, then how much amount you have to deposit in the bank?
By formula we calculate, sir.
So which formula you use?
R divided by FE minus 1.
So it is IC. IC is equals to 1 upon S. And 1 upon S, you know, R will be in the denominator, numerator, and it will be S is F1 minus 1, and R will go in the numerator. So it means if you have to get rupees 1 as sinking fund, you have to deposit this much amount every year. Is it clear? Now let us suppose you have been collecting this, you have been depositing this much amount for n number of years. So if you are depositing rupees 1 every year, let us suppose if you are depositing 1 rupees for n years, what will be the amount collected? If you are depositing 1 rupees in the bank at R% rate of interest, it will be equals to S. S is a cumulative sum of rupees 1 deposited every year at R% interest. It means if you are depositing 1 rupees in the bank, you will be getting S. And if you are depositing IC, then how much amount you will get? So it means in n number of years, you will get this much amount. After n years, you will accumulate this much amount as sinking fund. And our depreciation is equals to the amount of sinking fund deposited up to the time when we are calculating. That is what this sinking fund depreciation definition says. What it says, it says depreciation at any intermediate stage is the amount collected in the security up to the date of valuation. So in practice, however, depreciation is accounted by assessing the amount required every year for recapturing the depreciated value by the end of life of the building. And the third method is reducing balance method. It is also called linear percentage method. It is also called WDV method, written down value method. So in this method, what do we say? Do. What is the difference between straight line method and this reducing balance or linear method? See here, in this case, depreciation every year is 1.5%. See here. Depreciation every year is 1.5%. Means if you have to calculate depreciation after this, here it is, if you are calculating for 20 years, it is 30%. If you calculate it for 40 years, it will be 60%. If you calculate it for 50 years, it will be 75%. Means every year depreciation will be 1.5%. But in linear percentage method, linear method, reducing balance method, and WDV method, what happens? So depreciation is applied on the reduced value, reduced percentage. So in the first year, if it is 100%, let us suppose you apply 3.5% depreciation. First year, it will be 100 minus 3.5, 96.5% will be the remaining cost. And in the next year, depreciation will be applied on 96.5%. If you applied 3.5% on 96.5%, it will become 3.3775%. So if you take the example in 20 years, there the depreciation was 30%. Here, the depreciation on the assumption of 3.5% annual, it will become 50.96%. So what happens is that ultimately after 60 years, the balance left in this case will be only 11.8%. That is almost equals to salvage value. So the straight line method gives you uniform rate of depreciation of the structure. See, this is the main difference. The straight line method will give you uniform rate of depreciation of the structure. Many times this question will be asked, this type of, you may get 1 mark question based upon this. And the sinking fund, What about sinking fund? The sinking fund method gives slower depreciation in the early years of the structure, because much less amount will be collected, much more as sinking fund. In the first year, sinking fund will be very less. As the age of the building grows, amount of sinking fund grows, and your percentage of depreciation increases. But what about in this linear or reducing balance method? It is opposite. In the early stages, it is faster, and as we go, it is slower.
It is faster, sir.
It is faster in the early stages. So basically, as an engineer, we are more concerned with this straight line method because it gives us some practically seems to be, but otherwise, if you think practically, what should be the condition? It should be that in the early stages, depreciation should be slow, and in the later stages, appreciation should be higher. But what happens in straight line? It is uniform throughout the life. And in linear method or WDV method, it is higher in the early stages and lower in the later stages. So you may get MCQ over these definitions or over these methods of depreciations like this. Which method gives you what type of depreciation in the early stages or in the later stages of the life? So problem here is that all the three methods will give you different percentage of depreciation. So as we have already discussed in morning session that we can apply sinking fund method in, we especially apply this in capital gain or income tax purposes. Otherwise, we generally use straight line method, or we may use this linear method or WDV method. Now we will see that how these methods basically works internally. We will take an example that will make the things clear to you that how these methods internally works. See this, we will take one examples in which we will do calculation for depreciation by using all the three methods. This is very important, not from examination point of view, but for understanding point of view. This numerical is very good. It will explain you each and everything about the three methods. Say temporary shed has been constructed for rupees 1,20,000. Assuming the salvage value at the end of 6 years as 30,000, determine the amount of depreciation and book value by first by straight line method, second by constant percentage method, and third by sinking fund method. So first we will consider straight line method. In straight line method, you know the formula is C minus S upon life. So C original cost, it is 1,20,000. Salvage value is given to you as 30,000, and life of the structure is 6 years. It is given. So every year depreciation per year will be 15,000 every year. So see here, book value at the start, it is 1,20,000. Now at the end of first year, 15,000 will be depreciated, will depreciate. And total depreciation will be 15,000, 1,20,000 minus 15,000, it is 1,05,000 at the end of first year. At the end of second year, again 15,000 depreciation will be taken. Then what is the total depreciation? 15 plus 15, 30,000. So the remaining depreciated value will be 90,000. In the third case year, at the end of third year, again 15,000 will depreciate. Total depreciation will be 45,000, and the remaining will be 75,000. In this way, every year, same amount of depreciation will be there, and at the end of 6th year, you will left with, see here, you are left with salvage value, which is 30,000.
You need to remember this table. It's very important to understand the internal behavior of straight line depreciation. In the straight line depreciation, the amount of depreciation will be the same. That's why it is called straight line depreciation. It is different with constant percentage method. In reading, both the things seems to be the similar. Straight line and constant percentage. Straight line is always in a constant direction, but these are different in accounting form. In straight line depreciation, the amount of depreciation is always constant, but it is not to be confused with constant percentage method. What does it mean? We will learn after this example. But as of now, you should understand this table. This is very, very important to learn the internal behavior of straight line depreciation method. Yes, sir. Please continue.
And then the second method, constant percentage method. So you know the percentage, you can find percentage by using this first step. P is equals to 1 minus S upon C raised to power 1 upon N. SC is 1,20,000. S is 30,000. N is 6 year. And if you apply this formula, depreciation percentage per year comes out to be 0.2064. Now see how it works. In the first, at the start of value is 1,20,000. At the end of first year, how much it will depreciate? 1,20,000 multiplied by 0.2064. 1,20,000 multiplied by 0.2064, it will be 24,768. So what will be the depreciated amount? 1,20,000 minus 24,768, 95,232. Now in the second year, now the depreciation will be applied on this amount, 95,232. 95,232 multiplied by 0.2064. Percentage is constant. So, but it is applied on the reducing balance. So 95,232 multiplied by 0.2064, the depreciation amount will be 19,656. And the depreciated amount will be 75576. And now again in the next year, depreciation will be applied on 75576 multiplied by 0.2064. It is 15599, 15,599. And the balance is 59,977. So if you go on applying every year, see at the end, what is left after 6 years? It is approximately 30,000. 29,977. It is approximately equal to 30,000.
सर ये कॉन्सेप्ट को याद करने के लिए हम स्ट्रेट लाइन मेथड को कांस्टेंट
Straight line method is not constant percentage method.
नो स्ट्रेट लाइन मेथड को कांस्टेंट अमाउंट मेथड भी बोल सकते हैं.
Yes, sir, we can call it a constant amount.
ओके सर.
It is up to you. Otherwise, this constant method is basically reducing balance method. Depreciation is applied on the reducing balance. We may call it constant percentage method, reducing balance method, written down value method. Many names have been given to it. So see,
Even sometimes straight line method is called as ingenious method and constant percentage method is known as accounting method. ये भी आपको याद रखना चाहिए at the time of examination. They may confuse you by using different meaning of the same method. Straight line method sometimes called as PWD method or CPWD method or ingenious method of calculating the deficit. And WDV method sometimes called as accounting method of calculating the deficit. Yes, sir. Please continue. Sorry to you.
so see now in this case, depreciation is uniform throughout the life, 15,000 every year. But here, in the early stages, depreciation, see in the first year it is 25,000 approximately, and in the last year it is approximately less than 8,000. So in the early stages it is higher, but in practical it should be opposite. In the early stages, depreciation should be slower. As the age increases, depreciated should be higher. Now the third method. Third method is this sinking fund method, where you have to calculate IC. In IC, formula is R divided by 1 plus R raised to power n minus 1, where n is total life of the building, and S is 1 plus R raised to power n minus 1. Here on n is age of the building, and depreciation percentage, you know, it is IC to S into 100. So let us assume the rate of interest as 4%. Let us assume in both the cases. So what will happen? If you calculate this depreciation percentage in the first year, here if you put the value as n, and here also if you put the value n. So another thing you have to remember, salvage value. What is the salvage value? 30,000. So what amount you have to collect? See the difference here. Here it was, you were considering this amount 1,20,000. But in sinking fund method, remember, you have to consider what amount you have to collect. Here you have to collect 90,000, not 1,20,000. So you have to deduct this sinking fund from 1,25,000. It means you require a sinking fund of 90,000. And you put, if you put all the values, percentage, depreciation percentage in the first year will be 15%. And there is an 50% of 90,000. So now you have to apply 15% on 90,000, not on 1,20,000. So 90,000, 15%, it will be 13,500. Depreciation in the first year will be 13,500, and you will be left with, if you $90,000, if you have to write it, you can write it like this: 90,000 minus 30,500 plus 30,000 this salvage value. So it will be 1,06,500 at the end of first year. Now at the end of second year, depreciation will be 31%. Now this depreciation is applied on 90,000. See here, 90,000 into 31%, 27,900. So you have to apply 90,000 minus 27,900 plus 30,000 for book value. So if you have to calculate depreciated value, this is depreciated value. 90,000 minus 27,900, this is depreciated value. And if you have to calculate book value, you have to add 30,000 in it. In this way, if you go on doing this in the first, it is 15%, then 31%, then 47%, again 64%. Then in the fifth year, it is 82%, and in the last year, it will be 100%. And if you see at the end 90,000 minus 90,000, you will be only left with the salvage value. You will be left only with salvage value. So see here, what is happening? It is slower. It has less depreciation in the early stages, and as you go, amount of depreciation increases. Percentage increases as you go.
Sir, show me the calculation of IC and S, sir. Formula calculation.
So you can do that calculation.
So for N, you told me that for which N for
Sir, here N is what is for how many years you have to calculate sinking fund? You have to calculate sinking fund in for how many years?
total
In
life
how many years you have to accumulate this 90,000?
for the life of the for the total
Is
life
for 6 years.
6 years, yeah.
Okay. So this value will remain constant.
And what about R, sir? R you have not
R is 4%, sir.
4% in sinking fund, and for what about this?
We are taking 4% for both the cases.
4%.
So that is why in the last year, when N is also 6 for both the cases, it will be 100%. That is why it is 100%, sir.
Okay, sir.
In this case, for S, in first year N will be 1. In second year N will be 2. S will change for every year. First year IC will remain constant for all the cases. And N will go on changes. And in the last, what will happen? Both are equal. In IC, you are taking S and S. In this case, S also, S is 1. They will cross each other and you will get 100%. So now we'll be doing one example in which both the three methods will be used. The cost of newly constructed building was 1 crore 50 lakh. The life of the building is 75 years. Determine the depreciation in the 30th year of life. See here, you have to find it in the 30th year of its life. By straight line method, by constant percentage method, and by the sinking fund method at 8% compound interest. He has given you 8% compound interest. The scrap value of the building is 10% of its construction cost. So age is given to you 30 years, life is 75 years, salvage value is 10%. It means construction cost is 1 crore 50 lakh. Then scrap value or salvage value, whatever you can, 10% of 1 crore 50 lakh, it is 15 lakh. So you calculate the depreciation by straight line method is SE minus S upon life 1 crore 50 lakh. Life is 75,000, 75 years, sorry. So depreciation per year will be 1 crore 50 lakh minus 15 lakh. 75 divided by 75, it is 1 lakh 80,000 per year. And depreciation, total depreciation will be in 30 years, 54 lakh. Now see in the constant percentage method or written down value method, depreciated cost at the end of 30 years will be given by C to S upon C upon raised to power M upon N. This formula we have calculated yesterday. So put all the values. C is 1 crore 50 lakh multiplied by 1 15 lakh divided by 1 crore, 50 lakh raised to power 30 divided by 75. So it is see here. Now this is depreciated value. See the difference. Straight line method will give you depreciation, and constant percentage method will give you depreciated value. Here, if you have to calculate depreciated value, so depreciated value will be, what will be depreciated value here? Depreciated value will be 1 crore 50 lakh minus 54 lakh. Here you have to calculate depreciated value. But here it is directly depreciated cost or depreciated value. See the difference between the two formulas. When you are applying straight line method, it will directly give you depreciation. And when you apply straight line method, it will give you depreciation. You must know the difference between depreciation value and depreciated value. So here now if you have to calculate depreciation, then you have to subtract 1 crore 50 lakh or 59 lakh 70,000. It is depreciated value. Do subtract it. So depreciation here is 90 lakh 28,000.
Friends, you should remember the difference between both the concepts. In constant percentage method or WDV method, he will always ask you about the depreciation or the depreciated value, because depreciated value will be calculated automatically. In straight line method, he will ask you about the depreciated value to confuse you, because you will not get that depreciated value straight away in straight line method. You will get the depreciation. And all the three methods using the same example, so that you may be able to understand the basic difference between the three methods. Yes, sir, please continue.
So now see, in the third method, which is sinking fund method. In sinking fund method, first thing you have to know how much amount of sinking fund you have to collect. Here, 1 crore 50 lakh is the cost, out of which 15 lakh will be the salvage value. It means you have to collect 1 crore 35 lakh. Then IC, you know, R over 1 plus R raised to power N, and S is equal to 1 plus R raised to power N upon R. So in this formula, what is the value of IC? Sorry, what will be the value of N?
75.
And in this S, what will be the value of N?
30.
30. Okay. So you put these values. You will calculate, this value comes out to be 100. Sorry, S will be 0.00025 and S will be 113.8. So the percentage will be 0.0283. Means approximately 2.83%. So here the depreciation, see the difference. It is approximately 3,80,000, less than 4,000. Here the depreciation is 90 lakh, and here the depreciation is 54 lakh.
So as a valuer, you need to value the property. Which method will you choose for, and for which purpose? That is to be understood by you.
So if you're doing for banking purpose,
yes.
For banking purpose, you use this method. For capital gain or income tax purpose, you use, or for capital gain purpose, you use this method.
Sir, can you please explain the significance of this? Why we use it in IT or sir capital gain method?
Sir, see, in banking, you have to be conservative. In banking valuation, you have to be conservative, because based upon your, let us suppose if this depreciation is 90 lakh 20,000. Let us suppose, now see here, which method will give you highest depreciated cost?
Sir, constant percentage.
Sir, it will be sinking fund method.
Yes, a sinking fund method.
Which method will give you lowest depreciated cost?
Sir, this the lower depreciation cost, sir, we will get in constant hand method, sir.
Constant percentage
Straight line.
method, lowest cost percentage. I am not talking about depreciation, depreciated cost. So here the depreciated cost is 3,80,000. Sorry, lower the depreciation, higher will be the depreciated cost. Lower the depreciation, higher will be the depreciated cost. See that you must have understand the difference between depreciation cost and depreciated cost. सबसे
sir.
कम depreciation कहाँ पे है? Which method gives you minimum depreciation?
Yes.
Sinking fund.
Yes.
And which method will give you higher depreciated cost?
Sir,
Sinking fund. And where the maximum, where the depreciation is maximum?
WDV.
WDV, or we can say this constant percentage. And again, see, if you apply WDV method, means that if you assume some percentage, then there may be some difference also. So we will see an example with that. So if you are doing valuation for banking, it will be easier for you to be on the safer side. You will use this because it will give you the lowest value of the building, so that you are able to defend your valuation. And in this case, if you are doing it for capital gain purpose, your main aim is to save money of your client while within the limitations of rules.
Yes, sir. Got it.
Any doubt? But now see, it is not always the WDV method will give you the lowest, sorry, this constant percentage method will give you lowest value. There are many other things which are involved in it. Let us suppose we will take an example which will make the things clear to you. Now see what happens if you apply same percentage. Let us suppose you in this formula, building area is 1200 square meter, age is 25 years, life is 50 years, salvage value is nil. When salvage value is nil, you cannot use S upon C raised to power M upon N. Here you have to assume some percentage. Plot area is 2000. So anyways, see here in sinking straight line method, formula is C minus S upon life. C is 100%. And if you take it in percentage, if you calculate, we can calculate in terms of money, or we can calculate in terms of percentage also. 100 minus S is 0 because sinking, he says that salvage is nil. 100 minus 0.5, 52% every year. And if you calculate 2% per year, and total depreciation is 50%. And if you see, then your depreciation is 1 crore 50 lakh, and depreciated value is also 1 crore 50 lakh. So depreciated value of the building by straight line method comes out to be 1 crore 50 lakh. Now see, if you assume there is one method, this formula C into 1 minus P raised to power N, WDB, that is also constant percentage. There are two formulas. This is one of the formulas. And now let us assume that V is again 2%. As in the case of straight line method, we assume P to be same. And if you apply P, see now here, you put all the values, you get depreciated value. This is the depreciated value, which is 1 crore 81 lakhs. 1 crore, oh sorry, 1 crore 81 lakh 3,941. So here the value is 1 crore 50 lakh, here the value is 1 crore 81 lakh. You are assuming same percentage. And this is how you use the formula. It is not only the formula which you have to use, it is how you apply this formula to a particular case. It will depend upon. It is not always that constant percentage method or yes, sir.
Sir, in this particular problem, the depreciated value is higher than the straight line method. So, higher the depreciation value, the bank is going to accept that. Am I right?
So, sorry, sir, bank will not ask you. The bankers do not know how you have a calculated depreciation value, depreciated. They don't need know anything. What they know, this amount.
Okay.
Nobody will check how you have arrived here until unless there is some problem. The account becomes unhappy or anything. Once you give your valuation report, they will take this amount and keep your valuation report in the locker.
Okay. Okay.
And after a certain period of time, say, let us suppose that the account becomes NP, and then they will take out your report. And then they will check how you have arrived there. Whatever you have given, they will accept at first instance. But only when you have to explain it, then you must have credentials available with you, how you have arrived at this level, at this value.
Mr. Ajay Kumar, one thing to be kept in mind that you are not issuing the valuation as a valuer. You are not issuing a valuation for the bankers. You are issuing the valuation to safeguard the public money for which you are being appointed. Okay.
Okay. Okay.
We are no one to satisfy the bankers, and we are not authorized to satisfy anyone.
Okay.
We are there to safeguard the public money which is kept in the bank, and government has appointed us to value it.
So, sir, if I understand correctly, the valuation of any particular building may vary between two valuers as well, because the assumption may be different.
Yes, sir. Yes, sir.
Okay.
Now, which value is able to defend its valuation?
Okay.
That is a value.
Thank you, sir.
You have to increase your value instead of value of the asset.
Mhm.
And if you know the internal working of these methods, you will be able to understand which things you have to apply. That is why these things have been made clear to you.
Correct. Correct. Thank you.
So otherwise, in your syllabus, it is our duty to just tell you this is the formula and apply this, nothing else, as per syllabus. Okay, then. So this was all about this cost approach method. And our next topic is market approach method. So in market approach method, what you will be doing? In market approach, their basic thing is that when you go to do the valuation of an asset based upon market approach, you have to collect a lot of data basically. So value will depend upon the cost at sale price of similar property in the recent past in the vicinity of the asset for which you are doing valuation. Three or four things are important. One thing is that you have to compare the two properties. And for comparing the two properties, you have to find out comparable. You have to find out comparable. And comparable should be of similar nature. If you are doing valuation for residential property, then the comparable should be residential property. If it is of 100 square yard plot, 100 square yard building, then the comparable should be nearly to this 100 square yard. But it means everything should be as near as possible. And then you will compare the both of them and will decide the that similar building was sold for 10 lakh, that the value of this building is also 10 lakh. But this is not the end. Many times you may not be able to find out the exact similar comparable. It is not possible every time you go and find the exact similar comparable in the vicinity of the build asset for which you are doing valuation, which has been sold in the recent past. Then you have to make some adjustments. So here your experience will come into play. And the basic aim is to कि इसके क्या है कि गरीब को अमीर बनाना है, अमीर को गरीब बनाना है, दोनों को एक लेवल पे लेके आना है. जब एक लेवल पे आएंगे, when they are out on both of them are at the same level, then you can say that the value of this asset is so and so. That is your market approach. Means find out the comparable as near, as similar as possible. And if it is not so, then make some adjustment and try to make bring them at the same level, and then decide what should be the value of that asset or building, whatever it may be. That is called market approach. So, Sandeep ji, we will have a tea break for a certain period of time. After that, we will start this market approach.
Yes, sir. Yes, sir. So friends, now till now we have understood the income cost approach. Only one approach remaining, that is market approach, and that will take around 2 to 3 hours to understand. And we will take a short tea break of it is 4:30 now. We will rejoin at 5 p.m. Till then, you can switch off your screens, and after the tea break, we will continue to understand about the basics of market approach, because while calculating any value for any property, you need to calculate the value of the land on which that building is constructed. And for finding the value of the land, you need to calculate the value of the land most appropriately by using the market approach method. And market approach is the most